going a little bit more in depth on rig, also known as Transocean. And brace yourself, because FOMO is not only coming, but it is here. It's been a powerful run so far this year for rig, and that leaves a person fearing missing out even more. So here we are, and let's see what's to come. So yet again, another week went by, and another week that I didn't buy anything. Pretty much for a month now, everything I've been looking at has gone up, which really hasn't allowed me an opportunity to get in. And here I am. Even though rig did pull back around 8%, but that wasn't sufficient for me to buy in. So that might be my bad. In hindsight, time will tell. Peabody, BTU, nothing new is really going on there. So I'll keep my eyes on the market, stay disciplined, stay principled, and see what's to come. If you look over the last year, Valaris has been doing pretty well. Actually, Valaris has been doing phenomenal, and Transocean has been lagging behind. But if you notice, in the last few weeks, Transocean really kicked it into gear and is almost caught up with Valaris now. And who's to say whether that momentum will continue? But if the industry and sector keeps on doing well, it shouldn't be of surprise that it outperforms. Now, of course, there's going to be more volatility with it, because there's more risk with it. But as we're going to discuss, that risk actually is improving. So here we have rig, Transocean. Stock charts, anybody can use this. It consolidated for 2 years. And the question is it now breaking out? Or is it a bull trap? Yet again, time will tell. You could say that the RSI is almost overbought and therefore it needs a pullback. And look at what happened last time the RSI got overbought. Well, I'm not a technical analyst, and there's a lot more fundamentals going on. So beware of using something so minute and unidimensional as a RSI indicator to cause you to trade, and probably overtrade and miss out on a lot of moves. Because if you're using that, then you very well might be trying to trade around your position and trading too large of a position around your position, and you're going to miss substantial moves. But you do you. So we have a lot of positive news. Here we have more launching of coverage with a buy rating. And what you see in these cyclical industries is that everybody gives up on them, all the assets are distressed, bankruptcies happen, and everybody stops paying attention. And then it muddles along for quarters or years, and then things start turning around and inflecting, and a new bull market is being birthed, and then coverage starts happening again. And this is to illustrate, regardless of the current price or the price rating or their targets, because I wouldn't strongly recommend paying attention too much to people's targets, because they just kind of muddle around in like a standard deviation range and maybe a couple dollars higher. You see that with oil analysts and forecasters. They just kind of flutter around the futures curve, and it's not helpful. It's not helpful. But what is helpful is the metagame, which is the increased coverage which is occurring on these stocks coming out of a cyclical low. And there's a couple of notes I'd like to point out here. Favorable geopolitical backdrop. The Russian invasion of Ukraine has shifted the focus from energy transition to energy security. Instead of blackballing oil and gas, governments are now scrambling to find alternatives to Russian supplies. That just sounds like a bunch of cope and fallacy and post hoc rationalization to me, because it's a rounding error. Even though it is a catalyst, yes, but it's not the largest catalyst, and the bullish thesis around oil was well in advance before the Ukraine invasion ever occurred. This is just recency bias and selecting the last thing that makes you sound smart, and yet again is one of the smaller factors that is contributing to this. And then the price target and valuation. Our price target is $7.50, or 8 times estimated 2024 EBITDA of $593 million. The target multiple is within fiscal year to historical range of 6 to 8, or 2-year range. So the point of this is that they're actually, see, one of the mistakes people do in inflection periods is they look back. They look at the trailing 12 months and then try to linearly project that into the future. And the past, now people say this time is different. The problem with this time is different is it's a level of analysis time frame issue. This time is different if you mean by time, because it begs the question, what do you mean by time? And to say that this time is different is to say that this 12-month period is different than the last 12-month period. That is true. But the idea that the commodity cycle isn't going to inflect and then crescendo back down at some point in the future isn't true, because it will. So you can say, oh, I've seen this game played again, and you saw what happened in 2014, 2012, 2014. It's like, yes, but I also saw what happened in 2010. So you have to play this isn't a multi-decade hold stock. It's a terrible business that's going to probably leave you to bankruptcy if you round trip it. That's not the point here. We're not trying to round trip it. We're trying to catch the inflection, gain the majority of the move, and then get out, and probably give some back at the top. You leave some on the table at the bottom, and you leave some on the table at the top, and you might get a double or a triple, and instead of it capturing the entire move, which really no one's going to do, of say a 5x, you get a 3x. But is that such a bad thing? I mean, really, people, is it? Will the liquidity needs being solved through at the markets be stopped, or at least reduced? So Transocean recently announced over $1 billion senior secured note deal for 2030, and they're going to pretty much, the point of this is to, it's the idea that the rolling stone gathers no moss and the rolling loan gathers no moss. And what they're doing here is buying time. They're pushing back maturities of debt, because one of the main concerns in regards to Transocean has been the maturity of debt in the near-term future and their solvency. And I believe it was the last at-the-market share dilution capital raising that occurred a few months ago was to help ensure that they didn't violate debt covenants of having, I believe it was 500 million cash and cash equivalents. So it kind of gave them a buffer. But by allowing them to further extend the maturities of their debt, hopefully that will also reduce the probability of them having the need to dilute shareholders any farther. Plus, utilization rates and day rates going up will hopefully generate more cash flow, and as well won't need them to dilute shareholders. Another interesting point, because we asked, is this a bull trap or is it finally breaking out of a 2-year base? So the short interest, this percentage of the float, is around 18%. And, well, it's probably not good news for those who are short. And that's all I have to really say about that. So here's some more coverage. Because yet again, as we discussed, more coverage happens because you can look at it detached from whatever particular sector you're engaged in, that if that sector is gaining more coverage, if you just use coverage as an indicator to whether a cyclical commodity business is where it's at in the business cycle, if I just mapped a chart of increasing coverage and decreasing coverage, you could probably gauge where in that cycle you are. The point I'd like to note on this, you can read it if you want to, but The point I'd like to note on this is that Saudi Arabia and the United Arab Emirates are each relying heavily on offshore drilling to increase their oil production capacity by 1 million barrels a day as of 2027. That's happening offshore in the Persian Gulf. And they're going to have a bunch of jackups. And that might not necessarily affect Transocean. I mean, it's not going to affect Transocean, but it will affect the industry at large. You get these sympathetic moves in the market. So even if something is good for jackups and you're not part of jackups, don't think for a second that people aren't going to flood into the market and just bid everything in the sector up, because they will. So that's also a catalyst. And this should also note, because the meta narrative of this is that they're having to invest billions of dollars of dead money for years to come to increase capacity by less than 10%. And people talk about peak oil, and what this is saying is that they don't have a lot of spare capacity, even though everybody thinks that's a conspiracy theory and they're just holding back. But they're showing to you, I say many a times, if there's a discontinuity between a person's speech and a person's actions, you look at their actions and you infer the intentions. And that could be conscious or subconscious. But here they are showing you their actions. And this is how you keep constant your comparisons and controls for variables. So if your narrative and your conspiracy theory is that they're just withholding a bunch of production, then why would they be investing billions of dollars into the future for offshore drilling? Because that would tell me that this idea of spare capacity is wrong. So that's something to think about. So what we see, as I've noted a few times in these cycle inflections, is there's more coverage. Wall Street, Barclays, analysts start upgrading. I believe it was a few months ago that Barclays gave a double upgrade to Transocean. David Anderson, I believe, was his name. The refinancing of debt to extend the maturities. People aren't that, well, this isn't true. You can see this at different points in a cycle. But one of those points in a cycle, because we're controlling for the variables and looking at everything on the board, is that if you think they're going to go bankrupt, you might extend the maturities just to give them time to not go bankrupt and default on the debt because you want your money. But another reason why you might extend maturities is because you think that they're going to do well, and so you open up the money markets to them and allow them to finance themselves to be able to do well, to then pay you and your coupon. Upgrades in rating. I just noted that with the David Anderson double upgrade. Stock price re-rating. We're seeing this. It's going up. How's that for a re-rating simplicity? And this is all indicative of a sector, and a section of a sector, because you have oil and gas. So you have industries, and then you have sub-industries, sectors and subsectors. So the section of the market which is offshore oil is disproportionately smaller than the rest of the industry. So you have an inflection of overall industry, and then some of those sub-industries start doing better before others. And now we have offshore oil catching up, and been catching up. So as the saying goes, that I believe I heard from Raoul Paul on Real Vision, buy bonds, wear diamonds. Well, let's mix that up a little bit and say buy offshore and wear Rolexes. And that's all I have for you this week. And you might ask, if I'm so bullish on rig, why have I not been pouring more into the shares? And the honest answer to that is because historically, my chasing of stocks hasn't worked out with me. Even though I know sometimes you wait for something to happen, you wait for a catalyst, and you back up the truck and you buy, and then you hold, and that's that, and it might retrace, it might not. But the risk of not being exposed to the stock is more than being exposed to the stock, and that's a real probability. Much of my problem here as well is that I don't want to over position size my portfolio so early. And these things have really ripped. And maybe that 8% pullback that we saw recently is all we get. And well, I'll be kicking myself, I suppose. But the good thing is that also, since the portfolio is so small, if say you have 33% of your portfolio invested in something and it goes up 10%, that's equivalent to having 100% of your portfolio invested in something and it going up 3 1/3%. So right now I'm not hurting too much because of it. But I am building up a cash supply to, well, buy things. Sooner than later would be nice. We'll see if I get that. Thank you for watching.